Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome to America's Commercial Real Estate Show. Thank you for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with, and laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host of the world of commercial real estate. Thank you for joining us. Remember, if you have any questions or comments related to this show or about any commercial real estate related endeavors, give us a call at 888-612-SHOW, or you can email us at info@creshow.com. You can also connect with us on Twitter. My account is @BullRealty. Our topic today is real estate partnerships and syndication strategies. Look, it's a great time to buy commercial real estate. We just went through one of the deepest real estate-related recessions we may see in our lifetime. In the worst sectors and areas, we're at the bottom of the market, and in most sectors and property types, we are well into the recovery period. Prices and values will be increasing, and they are increasing in a lot of cases right now. If you have the cash, you should be, or probably are, investing right now. But what if you don't have enough cash to go it alone? Maybe you're considering group investing, partnerships, or syndications as a way to invest in the current market. Well, today we're going to talk about group real estate investing and private placement offerings. We're going to share tips with you for partnership agreements and group investment structuring. We'll start with some benefits for sponsors and investors and some basic considerations to keep in mind. Then we'll get in a little deeper and cover some of the latest strategies and mistakes you should avoid. Plus, we'll share an update on the latest requirements of the REG D regulations and securities acts regarding raising funds and solicitation of investors. Please welcome my guest, Gene Trowbridge. Gene Trowbridge, Esquire, CCIM, is a real estate attorney, a CCIM commercial real estate trainer, and an author. His law firm's practice is centered on matters concerning the syndication of commercial and investment real estate. In the last 18 months alone, his firm has produced PPM's private placement memorandums for over $150 million in syndications. Plus, he has prepared partnership agreements, entity formation, and group investment structuring for hundreds of clients. He is a member of the CCM faculty since 1979, where he has been honored as the Institute's Instructor of the Year and holds the CCIM Distinguished Service Award. Gene is also an author. I recommend his latest book about real estate syndications, It's a Whole New Business. Gene, welcome to the Commercial Real Estate Show.
Well, thank you, Michael. It's exciting to be here and talk to you and your listeners.
Well, thank you, and our listeners around the country are, I think, interested in this subject because it's a great time to buy commercial real estate. And as your book says, it is a kind of a changing world out there. And let me ask you, let's say that I feel like this is one of the best times to buy commercial real estate. I don't have enough cash to go it alone. I have a track record in the business, so I feel like I'll be successful reaching out to investors to partner with me. What are some of the first things I should think about to get started?
Well, Michael, I think one of the first things is to understand that this is a new business. No matter what you've done in real estate, you've really probably concentrated on the property. And in the syndication business, you're much more concentrating on the investors. You actually, for the first time, have investors who give you their money, and now you're in charge of the money. The money flows through you into the property. Then the money comes out of the property back to you and back into your investors. So I think one of the first things you have to deal with is it's a different mindset. And, that's why I called my book It's a Whole New Business, because it really is something different for most of the real estate professionals that I deal with. Then another thing I think you should be aware of is that this is not a nothing down play. You're going to have some money to do this. The syndication business can be expensive. Not every property can be syndicated. It takes time. to do a syndication, but you're just not going to be able to come and go in this business with no money of your own. And then I think the last thing I'd be concerned about is, have you assembled a team around yourself? Do you have a good attorney? Do you have an accountant who understands the real estate business? And I'm just assuming through all of this that the listeners, Michael, and your audience already have the real estate knowledge of the product and the product type. So what they really need to do is they need to add more expertise to this new business that they're entering into.
Well, that's a good point. And what about the types of partnerships that someone might put together? As far as, I've heard some of the funds that we deal with have blind pools where they've got a lot of cash sitting there and they're ready to go. Then you have specific partnerships that have a property in mind. Tell us a little bit about that and what you recommend there.
Okay. All right. I'm going to approach it in two ways. First of all, the specific offering, Michael, is where the sponsor is going to be able to tell their investors that we're buying that building right over there. You can see the building. Here's the property package. You have all the information about the property, just as if you were going to buy it yourself. But you're not going to buy it yourself. You're going to invest with another group of investors. That's probably an easier sell to investors, especially if you're a beginning syndicator, if it's your first several deals. Offer a specific property to your investors. As you get some track record built up, you get some expertise in property type, running syndications, you can step into the blind pool world, which is simply, I have a business plan. I'm going to go out and we're going to buy buildings like that building across the street, but we're not going to buy that building. But we're going to buy several buildings just like it. You give me your money, and as an acquisition strategy, I've got all this money to start with. We can negotiate a good deal. We can close quickly, and we can control some property, and we can compete out there with all the other investors who are bringing a lot of cash into the marketplace today, and sellers are not going to wait 60, 90 days. So a blind pool really is an acquisition strategy that the sponsor can use. But the sponsors that I have who fail in their money-raising efforts generally are doing blind pools too early in their syndication career.
Right. Just give me your money and I'll just do what I want with it, right? That's a little harder to raise cash that way, right?
Well, you really need a good business plan, a 4 or 5 page story, not a lot of numbers, but the concept. One of my most successful clients syndicates mobile home parks, and they've done quite a few, and they have a great business plan. It lays out exactly the right parts of the country that they're going to buy, the type of parks they're going to buy, what they've done in the past, and you look at that business plan and you know exactly what you're going to get when you invest. And one of the beauties for an investor in a blind pool is typically there are multiple properties, so the investor gets a chance to have their money diversified across products, and that should limit the risk.
Right, and in that example, that sponsor's bringing something to the table. They have expertise in that property sector, so you can invest with them and get the benefits of that experience, right?
Absolutely. We did have one sponsor once who insisted that they were going to do a blind pool for just to buy one property. And what they found when they went to the investors is the investor says, well, why didn't you wait until you find the property and show it to me, and I'll tell you if I want to invest. So that didn't work.
Right, and the nice thing about a blind pool is then you have the show me money, and as brokers we sell a lot of properties for banks and servicers, and a lot of times there's competing offers, and the sellers do like to see that cash sitting there, and they might choose that buyer over the other, but you've got to look at your capabilities of raising cash and see what you can do there, right?
That's right, Michael, especially today in the multifamily business, which is really heating up. There's a lot of competition for good multifamily properties, and most sellers want to see some proof of funds, which brings me back to something I said earlier. Not every property can be syndicated. If there's a property that the seller is advertising you have a 15-day look, we're going to take the highest bid, you probably can't syndicate that property unless you have the blind pool already set up, because you just don't have time. You need 60 or 90 days to really put together a syndication and get ready to close, I would say, from the time you go into a letter of intent.
Right. And I want to get into some of the regulations and requirements of registration and things with these partnerships. And before we get into it, though, we'll have to do that in the next break. What is the quick definition of a partnership where it's could become a security?
The plain English definition I use all the time, Michael, is when an investor invests their money in a common enterprise with other people, and the investor expects a profit, and the profit comes through the results and the efforts of the sponsor. And that last point, the profits coming through the efforts and the results of the sponsor, is really what makes it a security. So there's all sorts of things that are securities that people don't think about. You can have a security with one other investor if you're the one who's making all the decisions. I don't care if you call it a joint venture, a partnership, a corporation. Those are just names of entities. Mm-hmm. Okay. The issue is you got the money. You're making the decisions. The investor's counting on you. That's a security.
Okay. All right, we're going to get more into securities. I'm Michael Bull, and this is the America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcast. On last week's show, we shared intel on some of the top college real estate programs in the country. And the week before, we interviewed top office tenant reps with Colliers, Jones Lang LaSalle, Cressa, and Bull Realty about the latest office tenant strategies in this market. There are lots of interesting shows to choose from. You can access the shows on iTunes or on your computer or smartphone at the show website, commercialrealestateshow.com. Well, my guest today is Gene Trowbridge, an attorney, real estate instructor, and author who specializes in real estate syndications. And Gene, I'd like to talk to you about partnerships and whether they're required to be registered as a security. How do you know that? How do you deal with that?
All right, Michael. We just talked about one of the issues on determining if something is a security, and that's whether the sponsor has enough control to be in charge of making the results of the venture be a positive or negative. And if the sponsor has that control, it probably is a security. So what do
as opposed to if all the investors make decisions jointly, right?
That's right. So one of the ways some of our sponsors try to keep their offering from being a security, especially if there's only one investor, and we have quite a few sponsors who do deals with one money partner, is we do something called a member-managed LLC. And in a member-managed LLC, it's just as you said, Michael, everyone gets a chance to vote, and so we minimize the prong of the securities test that says the results are totally dependent on the efforts of the sponsor. But the problem with a member-managed LLC is you can't have too many people in it because you'll never get a decision made. So somewhere along the line, a manager steps in to make the decisions, and then that's called a manager-managed LLC. And in almost every case, a manager-managed LLC is a security. Now, it shouldn't scare you away that you might be doing a security. I mean, most of the investors want a manager to run the project, to run the fund, to make the decision.
That's the benefit,
what they're
right?
Investing for, right?
That's the benefit, right? You have the sponsor who knows what he's doing.
Yeah. So don't be afraid of making it a security. It's just that you have to follow the rules. And the first rule we have is that if it's a security, every security has to be registered with the SEC unless it's exempt. And last year, 2011, the latest figures we have, there were almost $1 trillion raised in exempt Regulation D offerings, which would be member-managed securities offerings across all areas, not just real estate. But that's a lot of money, $1 trillion. So people are doing this every day. And how do we keep our security from being registered? Well, we keep it exempt, and that generally is a private placement, investing with people that you know, and up until this time, no advertising or general solicitation. If you have a pre-existing relationship with your investors and you don't attract them through advertising, you can follow the rules of Regulation D, have an exempt offering, and move right ahead with your syndication business.
Okay, so no ads in the paper?
Yeah, no ads in the paper. Now, we're going to talk a little later about what's happening in the Jobs Act right now as we speak, and let's cover that a little later.
Okay, and let's talk about some of the other exemptions now. What about accredited investors? What makes an investor accredited so that you can be exempt?
An accredited investor is simply a definition. It's, in plain English, it's a person who's either rich or smart.
That sounds like all my friends.
Yes, they used to be, right? Rich and smart. And now the SEC has defined rich to be an individual investor who has more than $1 million of net worth, not including their primary residence. That was a big change that came from Dodd-Frank in the last 2 years, taking out the equity you would have in your primary residence when calculating your net worth. The second way you can be determined rich is if you are an individual who earns more than $200,000 a year, or if you are a married couple and your total combined earnings is $300,000 a year. Those two definitions make you rich. What about you accredited?
Now, what about smart? Do they have to read your book and listen to my show to be smart? Is that the example? What's the smart part?
Let's see if we can get that written in the rules. Okay. Smart is much more difficult. The simple way to define that you're smart to be an accredited investor is to have a registered investment advisor work with the investor, and the registered investment advisor will determine if the investment is suitable for the investor, and then that registered investment advisor signs off on the subscription agreement and says that this is a suitable investment. And that registered investment advisor has to be working with the investor. That's the client relationship, not between the sponsor and the registered investment advisor. So smart's a little tougher to qualify as accredited. In today's world, Michael, many of our sponsors are just simply sticking with the annual income test, the $200,000 or the $300,000, because the elimination of your primary residence from your net worth requirements in certain parts of this country was a devastating change to the definition of rich.
Mm-hmm. That's right. But what about smart? So they still have to be smart, right? They
still have to be smart. Now, okay. If you're not accredited, you can still invest in a Regulation D offering if you're sophisticated, which is a lower level of smart. Sophisticated means that the investor on their own or with their advisors, like their attorney or their CPA or uncle, if their uncle is Warren Buffett, Warren can tell them that this is a good deal for them. And that's okay. You can take those people in your investments if they're sophisticated. You can take up to 35 of those in every one of your syndications, and you can take an unlimited number of accredited investors. There's another issue about the accredited investors. Given the fact that they're rich and given the fact that we think that they're smart, the rules say that an accredited investor does not need to receive a private placement memorandum. Well, a lot of sponsors think that's a good deal. Gee, I don't have to write a book. I don't have to give the investor all the information. Well, that's not really going to work, because in the securities world, you're required to give the investor all the material information they need so they can make an informed decision before they invest. Even a rich person needs all the information, right?
That's true. And I want to get into about PPMs and some of the ways to safeguard your investments strategies out there if you're bringing in partners. So stay with us. We have more intel headed your way. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. How would you like people to come to your website to hear the Commercial Real Estate Show? Well, now you can download a free widget allowing your site visitors to access show videos and audio podcasts right on your website. Just visit commercialrealestateshow.com and look for the widget on the homepage. You can see how it works and you easily download it to your site. After you load it, it works automatically. Our topic today is real estate partnership and syndication strategies. My guest is Gene Trowbridge. And Gene, I'd like to talk about some of the other precautions and possible mistakes that someone should avoid when they're putting together a group sponsorship like this.
Okay, Michael, I think the overriding mistake that and precaution that people should be careful of today is making sure that you tell every investor exactly the same thing. And that leads to one of the important reasons to have the documents ready when you go out and raise money. In the heat of selling and negotiating with investors, I know that some of my sponsors get trapped where they start telling one story to one person and a slightly different story to another person, and then when they get all through, they've told 30 different stories, and it's just better to have the written documents done ahead of time. You lay them in front of the investors. Every investor gets the same information, which is, the basics of the security law, the material representation, and you keep yourself out of trouble. The other thing I think we need to worry about is rules on advertising. While the Jobs Act is going to give us some flexibility on that, most of the sponsors are still going to have to follow the rules that says there's no general solicitation and no advertising allowed on most of the Regulation D offerings. So those are the two things that I think that someone should be careful of when they're out seeking investors.
Right, you have to be careful there. Well, Gene, talk to us about the basic documents that are needed to put together a sponsorship.
Yes, Michael, we've used the term private placement memorandum already in our conversation. Sometimes people shorten that and call it a PPM. Sometimes it's called the offering documents. It really doesn't make any difference what you call it. I think what you're going to give an investor, Michael, think about yourself investing in a piece of real estate with me as the sponsor. The first thing you'd want to know is you'd either want to know my business plan, if it's a blind pool, or you'd want to know the information about the property if it's a specific offering. You'd kind of want to know everything about that property just as if you were going to buy it yourself, even though you know you can't buy it yourself, you're going to invest with other people. So you need a good property package and a good business plan. The second thing I think, Michael, you'd want to know, and an investor would want to know, is what are the rules that are going to be in place when these 20 or 30 investors pool their money to buy this property? And generally today that's going to be found in the operating agreement of the LLC that the sponsors formed that accepts the money from the investors that actually owns the property. So we've got the property information, we've got the rules of how it's going to work in the operating agreement, and then I think from the sponsor standpoint you need a questionnaire and a subscription agreement. The questionnaire goes out to the investor and asks the investor, are they accredited? What's their level of sophistication? What does the sponsor need to know about this investor and the suitability of this investment for this investor before the sponsor takes the investor into the deal? Mm-hmm. And then there's really the contract, the subscription agreement. The investor says to the sponsor, I'd like to invest $50,000. Here's my check, or I'll wire the money to you, and in support of my offer to buy into your fund, here's my questionnaire. So you've got the subscription booklet with the questionnaire, you've got the property package, and you've got something about whether it's the corporate bylaws or it's the LLC operating agreement, the rules. And I don't care if you put a spiral binder on that or a staple or a clip or you put it on the internet. That's your PPM.
Okay, so those are the basic three or I guess four documents that you'll need to put together. And we're short on the break here, but you really need an attorney to do that, right? You better not use something you find on the internet.
That's true. The stuff that you find on the internet is okay for you if you're going to form your own LLC and you're the only investor. But the minute you start giving investors and individuals these legal documents, you're practicing law if you've drafted it yourself, and that's going to get you in trouble.
Yeah, that's a problem. Well, stay tuned for more intel from Gene Trowbridge on real estate partnerships and syndications. I'm Michael Bull, and you're listening to America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. We have some very interesting shows coming up for you, including a show on retail tenant strategies, a show on the hospitality industry, and my favorite, oops, I should have covered that in the lease. Be sure to catch all the shows of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Our topic today is real estate partnership and syndication strategies. My guest is Gene Trowbridge. And Gene, I'd like to talk about some of the other issues related to the advantages and disadvantages to investors of investing with a sponsor in a syndication process, and what should they do to protect their interest?
All right, Michael. The advantages to an investor, I think, really starts with the fact that this might be the only way they can get a chance to invest in real estate. They don't have enough money to buy a property themselves. They'd like to get into real estate, and the syndication industry works for that. I always, in my workshops or my classes, one of the first things I always talk about, what is a syndication? Because that's kind of a weird word. Well, when you get on an airplane and you fly somewhere, that's a syndication. You probably don't own your own airplane. You can't fly. You're not a pilot. So 150 of you get together and jump on a plane and get where you want to go. Well, that's the benefit of being in a syndication, and you relate that to real estate. Really, the number one benefit is just a chance to invest. You've already mentioned that we get good benefits from hiring professional management through a syndication, having the sponsor on your side. And I think another thing that's very important from my days as a syndicator was diversification. Even if you had the money to buy one property yourself, there certainly is a financial planning aspect to spreading your money out over 8 or 9 or 10 different properties to avoid some of the risk. So I like those 3 advantages. But I think some of the things that investors do that I don't think are real bright is they generally don't read the documents. The sponsor takes a lot of time and effort to tell the story in the documents, to give the investor all the information they need. And many investors don't read the documents, and I think that's a mistake. Another thing I think is a mistake is investors should really be careful and invest with people that they know. This really is a private placement world, and one of the beauties is to be able to invest with people who have a track record, and when you give them your money, you feel comfortable about it. And the last thing I think, and I know this from my experience as a syndicator, is don't be greedy. Investors often look at the yield. First question you get is, well, what are you paying? What's your yield? And if I said 16%, the investor might think, geez, I just saw a deal that was 20%. Why would I want to invest with you? Well, what does 16% mean? I don't know until I know more about the deal. So don't always invest for the highest yield, because that typically means it's the highest risk.
Right, so you might want to look for safety. You want to make sure that sponsor is someone you're comfortable with, and you probably want to look at the waterfall and see just how that yield is coming to you and when, right?
That's right. In talking about, looking at sponsors and what to look for in a sponsor, I'll just tell you the 3 questions that my sponsors get the most. The first question they get is, Michael, I'd love to invest with you in this deal, but I'm going to give you my money, and what happens if something happens to you? So the issue of putting together a continuity plan for the sponsor, which typically means you're not going to be an individual sponsor. You're going to have a partnership. You are going to have a team so that the investors feel comfortable in giving you their money.
Yeah, and I'll quit skydiving out of my G5 too, just to make it feel more comfortable.
And don't go skydiving with your partner either, it's the same thing. So that's a question. The next question you're going to get is, well, have you done this before? What's your track record? And everyone does their first syndication, so it's a chicken and the egg issue. If you haven't a syndication track record to run on, you have to start with your own real estate brokerage record, your own real estate investment record, and build a story for yourself. And I think the last question that my sponsors get of the top 3 is, well, if this deal is so good, Michael, how much are you investing in it?
Right.
And that, you hear the term skin in the game. I started my conversation with you and your listeners saying that this isn't a nothing down game. You need some money to be a syndicator, and one of the places you need some money is you need to invest right alongside of your other investors. First of all, that's where the money is to be made, is to make an investment in the real estate.
Absolutely.
So why wouldn't you want to invest?
Right, and they want to know that you have the confidence to put your own money in the deal, right?
Absolutely.
And what are some of the fiduciary responsibilities of the sponsor? I mean, do they have some responsibilities to these investors, right?
Sure. We could spend a whole interview on the fiduciary responsibilities, but let's see if I can make it simple. When the investor gives you their money, you're supposed to treat that money better than you treat your own money. Okay? I'll give you a simple example. Where I live, earthquake insurance. Mm-hmm. On my own properties, I might not buy earthquake insurance. But if I'm investing your money, Michael, and the money of 20 other investors, I'm buying earthquake insurance. That's my fiduciary duty to you and the investors.
Right. You got to take care of their money. Just as an example, too, I guess if you're a real estate broker and agent, you have more responsibility. So I guess when you're putting together a syndication like this and you're the sponsor, you're going to taking on those similar responsibilities of taking care of the people that you're dealing with.
Well, that's the one of the big differences in being a syndicator and being a broker is when you're a broker, the client never actually gives you their money. And if you're a syndicator, the client does give you their money. And I bet you've had a lot of interviews where people talk to brokers about how to get control of properties and how to do this and how to strategize. How about being a syndicator where the client just simply gives you their money?
That's right. For more on syndications in a moment, I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Our topic today is real estate partnerships and syndications. We have Gene Trowbridge with us, and we're talking about syndications. And Gene, what's new in the syndication world, especially regarding advertising and soliciting for investors? What's coming down the pike?
Well, Michael, the hottest thing is the results of the Jobs Act that the President signed in the spring. And the Jobs Act is going to make two major changes to the way we do business. One is that in the Regulation D, Rule 506 framework, the Jobs Act has required the SEC to eliminate the prohibition against advertising and general solicitation.
Wow.
As long as the sponsor is assured that all of the investors are accredited. So we talked about accredited investors being rich and smart. Now, in order to promote capital formation, they're trying to free up the sponsors to go out and find those rich and smart people and bring them into all sorts of different types of investments that are syndicated. And where we are right now on this is we're waiting for the final rules to be issued by the SEC. They've issued proposed rules. There's a comment period, and they'll be coming out this fall right away here with the final rules that is going to tell our people how we can advertise and what steps do we have to take to make certain that our investors are accredited. So we'd already talked, Michael, that last year we raised $1 trillion in the private placement business. If we can advertise for these rich and smart people, more money will be raised, and that's the whole purpose of that Jobs Act, is to increase capital formation. The next thing that sounds really sexy is called crowdfunding, and a lot of your listeners have already heard about crowdfunding. That's the proposal that comes out of the Job Act that says a sponsor can raise $1 million in each deal by advertising on the internet.
Wow. And
there's no requirements that the investors will be accredited. There are going to be some requirements of what an investor looks like, what's suitable, and there's a lot to it, but that could really be exciting in certain parts of the country where if you can raise 100 people $10,000 each and go out and do some syndication, that could be very exciting, but not so fast. The SEC hasn't even issued their proposed regulations on that. They're still back working on Rule 506. Then they'll get to crowdfunding. They'll issue their proposed regulations. They'll offer them for comment, and then we'll be ready to go. Just last week, I saw an email of someone who is sponsoring a crowdfunding workshop, and I was wondering, what would you do at a crowdfunding workshop when the rules aren't even issued yet?
Right.
You don't know what it's going to be. Everyone is guessing. And here's my caveat. Until the rules are finalized and issued and permanently, crowdfunding and advertising under Reg D 506 is still illegal. So don't jump the gun. Be patient, and we're going to be out there, and we're going to raise more capital than we ever thought of as a result of the changes coming from the Jobs Act.
Well, that's great. Well, Gene, thanks for sharing your insights with our listeners around the world today. We sure appreciate your time.
Well, you're welcome. I enjoyed it, and thank you very much, Michael.
And if you'd like to know more information and the latest on REG D or about Gene's workshops, manuals, or courses, or to order his book, It's a Whole New Business, visit his website, groupsponsor.com. Well, I have a question for you as a listener. Can you join us next week? Well, I hope so. We'll be exploring the hotel and lodging industry. Thanks for spending some time with us. I'm Michael Bull, and until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.